Mira Business FM. The sound of success.
It's the morning drive, Mira Business FM, with me, Tim Elliott, and James Thomas is here. Good to see you.
Likewise. Good morning.
Independent financial consultant that you are. So, personal financial information, news and views. You sent a topic through, James, and it is all about how AI is going to change how we bank. Now, I would argue that changing how we bank is probably more than welcome in any environment, jurisdiction, country, city, wherever you are. And it is interesting, but I tell you what we'll do, we'll save it, because the kind of central thrust of it is that the UAE's introduced new AI rules for the banking sector. So we'll look at what it means, but there's so much in this, and the overriding kind of headline is that the central bank is saying that human interaction is still really important. That's kind of the main thing I'm taking.
That's what I took away from it, because I know when we've been discussing, looking for news topics that are relevant to this segment, and this one sprung out straight away because I thought it really combines, modern new technologies, AI, this word, the guest you had on earlier today, and most of us bandy this term around and not really understanding how it connects to our life.
We sort of know, but how much do we really know? How much are we really sort of getting to grips with AI?
The central bank actually saying how it can be used and what things to look out for. Again, it just fits in really nicely with the sort of things that we have been discussing over the past number of weeks. Yeah. But as you rightly say, it's the conclusion, or it's to be aware. It's great. It can add some real value to your banking, but also not going to take away that human interaction.
It's not. It's a real bugbear of mine when I call my bank, and I actually try not to call the bank. I've probably bored you with this at length on a number of occasions in the past over coffee, but when you call your bank and it's if you want this, you've got to do this. You go through the menu and you eventually get there. And it's just really difficult to talk to somebody. And because it's your money, or it's to do with, I don't know, a credit card transaction, whatever it is, and you can't get to the branch because you're busy, your kind of expectations are heightened.
You're already on edge.
Stressed.
You're stressed.
You're on edge.
Because the reason you're not doing it for the fun of it. I know that sounds a stupid thing to say, but the reason you're picking the phone up because you've got an issue.
You've got to sort something out. Yeah.
And I won't name names, but yes, when you go through those automated systems, and either they want you to talk to it and it doesn't understand your voice.
Yeah.
Or
that's not at all annoying.
No. Or you press the options and it says, "Thank you very much," and you've been cut off.
Yeah, that's when I've smashed a few phones at that point.
You hurl it across the room 15 minutes and suddenly, I've got to start this all over again. Yeah. And it's, you just think, well, all I want you to do is have a few more people, rather than investing in all of this wonderful tech, in inverted commas, just hire a few more people that can take the call and then speak to me and say, "It's all right, James, it's all right, Tim, this is what you need to do, or this is what's going on. We'll sort it for you." That's actually what we're all looking for, is that proverbial arm around the shoulder, just to say, "Yeah, it's all good. We're on top of it. Yeah, we can help.
Don't worry, it'll be fine." I mean, 9 times out of 10, to be
ultimately
fair,
where you end up.
That's where you end up, but it's just
getting there.
The stress of getting there. That's the point. So the idea that AI will enhance, or hopefully that there'll be a balance between AI and human interaction. That's really important, I think. Yeah. So we'll come back to that story next week and look at it in some detail.
Yeah.
So a few things this week, and I know you wanted to start with the dollar-dirham strength. So here you go. Take it away.
Well, again, it was just a headline because I'm probably relating to what you were just talking about, tariffs and the dollar. Lots of, again, who's it? Mark Twain. My death is, what was the phrase?
But the certainties and life that are death and taxes.
Yes. Well, was that one, but also I'm trying to think. Of course, hopeless on the spot. I can't think. But my death has been over-exaggerated or something along those
Reports
lines.
of my death have been greatly exaggerated.
There you go. That's the one I'm listening. Because it's been the dollar's going to weaken. It's going to be devalued. Should I change my currency? Is it any more? Is it still the world reserve currency? Mm-hmm. The headline being Indian rupee, Pakistani rupee, Filipino peso have all weakened against the dollar.
Yeah.
So that is a complete reverse. The dollar is actually strengthening against three of the most popular or populous currencies here in the Middle East.
Yeah.
And I just thought it was a really interesting point of view to comment on and say, that don't believe the hype.
Okay, so the story is Indian rupee, Pakistani rupee, Philippine peso trading near multi-year lows against the UAE dirham.
Yes.
So what is driving? That's a sustained weakness, I suppose. What's driving it?
Well, again, my personal view, it's the ongoing strength of the dollar because it is still the world global currency. What do we all trade in? What are the dirham and most of, I think it's Qatar and Kuwait have got a basket of currencies, but they all still have a big percentage or all linked
in some way or
linked in some way, benchmarked to the dollar.
Yeah, okay.
And I just felt that headline was really interesting, just completely the opposite of what a lot of commentators had been suggesting was going to happen. Yeah. And why that then is and indeed I've had it with clients and prospects in the past. No, if I send my money back to India, for example, I'm moving into rupees, I can get a much higher interest rate back in my home country. Mm-hmm. However, I then just look at some longer term figures. 10 years ago, the rupee was at 18 to the dollar. 5 years was 20, is now nearly 25. So that's a 20% fall over the last 5 years alone.
Yeah.
So my point being, you move it into that currency because you think you can get a better interest rate, but it's then fallen by almost as much as the interest rate that you're able to generate in your home currency. So my argument would be if you're planning to stay here in the region, if you're returning to your home country, different matter. But if you're planning to stay here, you're better off actually just keeping it in dollars, investing it in dollars, even just earning interest in dollars, because while that headline interest rate may be lower, because the currency is actually proving to be a stronger currency than the alternative that you'd been considering or your home country, you're actually end up better off by leaving it here and repatriating it at a later date when you actually need that money in your home currency.
No, and that's good, prescribed, kind of sensible financial thinking, isn't it? And that's a long-term view. But I guess for a lot of people, so if I play devil's advocate for a moment, for a lot of people, it's, I need to remit money home for my family, and I'm going to get a better rate there. I'm going to do a bit more now, which is a different.
There's two different issues there. If it's for family, if it's for expenses back in the home country, well, actually is a good thing because the money is going further because the conversion rate is better.
Yes.
If you're looking to invest it, then not so good because you're what you're gaining in the enhanced interest, you're losing by the currency devaluing.
That's true. It depends on your primary driver.
It depends on what your driver is.
You're
absolutely.
Doing. But I think that's a really good point. And it applies to the Philippine peso as well. 10 years ago, 13, 5 years ago?
Also 13, but now 15.
13.
Yeah, so it was flat for 5 years, but now started to fall again. So 3% a year. It's not quite the same drop, but nonetheless, it's a 15% fall over 5 years.
Yeah.
So not insignificant. If the money was not needed back in your home country, you'd be way better off keeping it in dollars, investing it in dollars, and then sending it home as and when it was needed.
I was making notes on this last night, and one of my questions was financial advisors, which is you, of course, often urge caution despite favourable rates. What should expats consider before rushing to remit? Which you've just answered very successfully there.
So it was just a headline I just thought was really interesting because we know a large part of the expatriate population here remit money back to their home countries.
Sure.
If it's for family, that's obviously fine. And the exchange rate is just a benefit at the moment because you're actually getting more of your home country
take
currency
advantage.
and take advantage of it.
Yeah.
But if it's for investment purposes, then be far more cautious. That was really the conclusion. And as I say, just it made me chuckle because I'm easily amused that we've had all of this talk that we must, or that the dollar is, in its death throes, the demise of the dollar is imminent, and then you look at the numbers behind the headline. And it's very much the opposite.
You see, this is always the thing, isn't it? It's about, the media thing is big headline.
Yes.
And look at me. And actually,
clickbait,
often,
read my story. But
very often there's not much of a story.
There's not much of a story. Or it's a headline and it's very short term, as we saw a few weeks back when the new Fed governor was announced. Suddenly the dollar has rocketed back up relatively speaking. It increased quite significantly.
You're doing it yourself.
I'm doing it myself. But, we're talking 3-4% here, which is hardly, it's not moving 20, 30, 40%, which some currencies do. But nonetheless, over a longer period of time, it's significant and should be thought about. That's the point I was getting to, as always.
But that's where, that's your kind of, it's almost a mantra, isn't it? But it's about balancing those kind of short-term gains. Yeah. If you're thinking, more saving and investment rather than immediate, aid to family or whatever, with like long-term financial planning, and that's the point. And you would always advocate, look, we're in this for the long term.
Yes.
Kind of that makes a lot of sense. So that's one story this week. Another one, and this is a more general topic, but it lends itself perfectly to everything that you've been talking about there. And it's confirmation that diversification is always the best way. So inflation risks are rising. Investors are being told, buy scarce assets, real estate, infrastructure, commodities, precious metals, which is what we've seen over the last, particularly in gold, but obviously silver as well, for example.
Exactly. It was just another headline that I thought was highlighting the fact that huge amount of airtime had been given to these, what I would call quite niche sectors. And suddenly there's the headlines, no. Diversify. Keep diversifying. These are, again, going back to my core and satellite. All of these are peripheral that you can add some spice, some alternative investments to your portfolio, but stick to your core investment principles. So don't get carried away by the headline.
It's be aware.
Yeah.
But don't worry.
Don't
about the other stuff that's going on. Be aware and ask the questions, but don't fret about it. Because in the end, your thing would be, markets generally kind of. I'm sort of going slightly uphill here. That's generally what markets do.
The general trend is up, and the longer that you're able to invest for, the smoother that line is. Short term, yes, there will be peaks, troughs. As I've mentioned before, Black Monday back in the UK in the 80s, a 25% fall in one day. Markets are now set up. You can't actually do that. There are breaks in the market to make people just take a pause. But within 2 years, markets were back above that rate. So, but again, if you now look at a 20, 30-year time horizon, it's but a blip.
Well, it is. But the interesting thing about that, you point to Black Monday, which is 1987, right?
87. Yes.
Okay, so that's nearly 40 years ago.
It's nearly 40 years ago. But why I mention it is because it was such a historic event.
Historic moment, historic point in time. Absolutely right. But absolutely, completely out of character, out of the ordinary, really unusual. It doesn't really happen. And it's interesting that you point to these moments in time. So the two things that really I can point to. Okay, so the dot-com boom.
Yep. So late 90s, early noughties.
Kind of late 90s. To that global financial crisis, Black Monday, the Great Depression. After that, I'm a bit stuck.
Yeah.
And you're really talking about nearly 100 years.
100 years of history. Well, yeah. The Great Depression, we're coming up to 100. Yeah,
it's not
late
that
20s,
far away, is it?
1920s. But yes, look, use a more recent. The global financial crisis, 08, 09,
Sure.
While it wasn't in one hit, markets had fallen 50% from their previous highs, but they'd recovered 25 or so, 50% of that, so 25% in total within 6 months. Once they'd hit their absolute bottom in March 09, by September, half of that had been regained. So it's very much that bounce and then the realization, oh, we've gone too far here.
And this is, I mean, it's these are, you're looking through a lens here at history, and this is not to laugh at history or to belittle that in any way. It's to use it as a guide or a benchmark. It's something that you can benchmark against, so that perhaps you can do better for yourself.
Yes,
at this point.
But also, as I always say, not to panic.
Yeah,
especially if you're investing regularly for your retirement. It's actually a huge buying opportunity because markets have fallen, so you're able to buy more units, more things than you were able to previously. And when that recovery does happen, the bit we can't predict is when, but it typically is a when, not an if. You've then got more units, and it will all come back again.
Yeah, and then you're in a much better position than you would have been.
So it was just a really interesting that again it had reached one of our big news papers here, and it was just, I thought, very interesting. And it's just a story to say, really don't panic, don't get swept along in the
try not to jump in
and
let the tide take you out to sea.
Yeah.
Yep. I'm looking for something poetic to use there.
Yeah.
But you are right, and it is the reading behind the headlines, isn't it? To try to get the real picture, I suppose.
Because we see a lot of headlines. I've made so much money doing X, Y, and Z, but there'd be sadly many, many more people who would have lost a lot more by jumping in at the wrong time, right at the peak. And then the tide, whoosh, use that analogy again, takes them out.
Well, if you use the tide analogy, the boat sailed, hasn't it, really,
Yes.
if it's a headline.
Yes.
So I suppose there's always that point as well.
Absolutely.
We've got 4 minutes.
Okay.
So final topic, excuse me, is the Netherlands. And it's interesting this because I was talking to a wealth manager yesterday in this studio.
Okay.
He has been in Dubai for 4 years, Dutch, and he left specifically for this reason as well, and set up his business here. So I'll let you just run through what you want to talk about.
Again, I won't claim to be an expert in Dutch fiscal planning, but it was just a headline that really stuck out, that they have introduced or approved a proposal to tax investment returns. But the key part is unrealized gains.
Yeah.
On stocks, bonds, and indeed crypto.
Yeah, and this is a hefty tax as well.
And it's 36%.
That's right.
On any of the gains in those areas. But like I say, the key part is it's unrealized. In the UK, in the US, and pretty much every other market, it's only when you sell do those gains then get taxed.
When you realise the gain.
When you realise the gain. So you've bought NVIDIA shares, you've made 1,000%. But if you don't sell them, it's deemed to be unrealised gain and therefore not taxable.
Yeah. Okay.
So the key difference here, they're now suggesting or saying that it's been approved that you're now going to have to somehow complete a tax return. And again, I'm not sure but I think a lot of people, that's the comments that I've been reading, is the mechanics of how they're actually going to do this. How are you going to report? Have you got to then, because it's a completely different process to where we would be normally, because obviously you don't, until this point, report, is it gains just in that 1 year? Is it gains that you've enjoyed prior to that? And it could be really quite
It's explosive.
Explosive, yeah.
Let's put it that way. Well, the new system replaces the previous method because that was ruled to be unconstitutional. So it was taxing assumed returns rather than actual gains, and that's what our guest yesterday was talking about. This is the next stage. So this is box 3 taxation, as it's known, right? And it is unrealized gains on stocks, bonds, and crypto. So quite how this works, the mechanics of this, I got to be honest with you, I don't understand how.
Neither do I, but I just thought as a headline and something to be aware of. And if, again, a trailblazer, a European country introducing taxes on unrealized gains, where does this lead to?
Yeah, that's a good point. That's a good point. And what's the knock-on effect?
Yes, are other governments going to say, oh, well, this is a great revenue stream. Again, 36%, over a third of your profits are going to be taxed. Where does that leave? As I say, do other
lead you to Dubai?
Well, quite. But is it just for nationals? Then the next question: is it just is it just residents? Sorry, is it nationals? Where does this process move to? Again, I'm just asking a lot of questions, but it's such a fundamental change in how taxation is generally levied upon the population that it was just a topic that I thought should be discussed. And again, just to be aware of, make sure you take the right advice, maybe consider moving your investments into a more tax favourable jurisdiction so that these won't apply to you.
Sure. Well, it's a proposal to reform Box 3 taxation, likely taking effect January the 1st, 2028. But
so there is still time.
There is still time. 36% tax on actual investment returns, including unrealised gains on stocks, bonds, and crypto. So I think we'll get some more details and try and find, we can get some more details.
But as I say, my point was just to be aware of. It's such a change.
It should be part of the thinking.
It's a thought process. Right. Absolutely.
Okay, got you. That's all the time we've got today, unfortunately. Okay. James Thomas, independent financial expert. Appreciate you joining us. Thank you.
Great. Good to see you. Thank you.
It's Mirror Business FM.